All right, so we'll get started now. So you're all welcome to this presentation today. Thank you for being here. We are not going to waste time, so we are just going to get into this presentation. So first of all, before we get started, I'm just going to do a checklist of what you would get out of this meeting and basically what we are going to cover. So I believe everybody here has heard about at one point or the other how people are either making profit on the blockchain or losing money on the blockchain. Uh, Today, that is very common. If you've not heard of folks that are making money, you probably heard of those that are losing money on the blockchain. And I don't know whether you've tried to make money on the blockchain. I have. And if you've tried to make money on the blockchain, you're probably aware that one of the most popular ways today to make money on the blockchain is leveraging, what we most likely call pump and dump. Okay, maybe you don't know it as pump and dump, but basically the most popular way today on the blockchain to make money is pump and dump projects. So pump and dump projects are basically projects that you buy a token or a coin, you buy an asset and then you hold that asset for a duration, waiting for the price to pump. And then once the price pumps, you cash out and then you make money. So you dump when the price pumps and then you make profit. So that's basically what is called a pump and dump mechanism or a pump and dump project. Okay. And this is popular. And this is what most people, that's all most people know. Okay. As far as making money on the blockchain is concerned, that's what most people know. That's everything they know. Okay. So what we want to do today is show you what we call the straight line profit method. Okay. A way that you can make money on the blockchain without the risks associated in a pump and dump project. Okay. You can make money on the blockchain without losing your money, without losing your capital. Okay, because those pump and dump projects, as good as they are, as interesting as they sound, it has become a way where people have also lost their capital. So part of what we're going to do here today is show you a stable way that you can make money on the blockchain without blowing your capital. All right. So I'm going to start this presentation now. Okay. All right. So I hopefully you can see my screen. Before we go, by the way, if you can see my screen, just give me a yes if you can see my screen. Okay. Give me a yes if you can see my screen. Okay. All right. Endless World says yeah. All right, good. So before we go into the business of the day proper, I just want to take 2 minutes to show you how you can avoid being scammed by potential investment projects that could claim all your funds. Many times when you talk about investing money, making profit on money you invested, okay, people say, oh, they have come again. That's how I put money in the other project. And then I lost all my profit. I lost all my money and all that kind of stuff. So for your information, you need to know the kind of platforms that have claimed people's funds and crashed and collapsed. Most of the collapse that you have seen in investment platforms, mostly in Nigeria, are all centralized projects. Centralized projects. And it's important you know the difference between what is called centralized finance and decentralized finance. Okay. I'm not going to run through everything. I'm just going to take the most important things. The first one that is very important is that on centralized finance, you have what we call permission-based system, permission-based. To use a centralized solution, you must have certain qualifications. You must have, for example, to use the bank, you need to have ID card. You need to provide BVN, NIN, email. You need to provide certain information. You must do what is called KYC to use centralized solutions. Go and check. Many times when people tell me that, oh, I lost money on a platform, oh, I did this project and now I cannot, all my money has gone. The first thing I ask them is, how do you log into that platform? How do you log in to access your funds? And I tell you every time, without fail, they will tell you, they will show you a page that has a login screen where you need to put your email and your password. The challenge with all centralized solutions that require email, password, login, that you need to do KYC, all that. The challenge with them many times is, as you know, this code, this software, this third-party app, this centralized app that you will use to access your funds, to withdraw your funds, 99.9% those apps are regulated by people on the back end. Those are the people that approve your withdrawal or disapprove your withdrawal. And that means that a day can come, they will decide that, okay, we are not approving any withdrawal anymore. It's time for us to close this business. And that is what we are seeing. A day just comes where you cannot withdraw money anymore, or that withdrawal,
can you watch people so that we can have a
site
good argument? Can you
disappears.
meet people?
And like I said, 99% of the time, 99, go and check. Just look at the last project. Let's say you've lost money in a project. Just look at that project. You will realize that there was KYC
Mr. Joseph, please.
there to log in. Most centralized projects require KYC. Okay. And that shows that there's a human being behind that needs to approve or disapprove something, and you are trusting in an individual. When you compare that to a decentralized project, which of course have their own roots, which we are going to talk about now. In a real decentralized project, it is permissionless. You don't need an ID card. You don't need NIN. You don't need nothing like to participate. Everybody can participate in a real decentralized project. Okay. Somebody's saying that there's disturbing voice. Okay. All right. Okay.
Yes, you've been shouting. You have not been listening. That you should mute everybody.
Okay. Yes. Sorry about that. Okay. Okay. All right. 1 minute. Okay. 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 Sorry about that, guys. So as I was saying, on a real decentralized project, there is no permissions. Everything is permissionless. Okay? You do not need to wait on someone to approve a withdrawal. You don't need to wait on someone to approve an account. Okay? It's permissionless. There is no KYC. There's no login page where you need to put email and password. And you are trusting on code because there's no human in control. Now, on a centralized platform, the other thing is there are low returns. Okay? And that is why when you see the average person that sees high return solution on a centralized platform, okay, they begin to shout. They begin to scream that, oh, the money is too much. That's why the bank will not give you more than 6%. Okay. Now, on the blockchain, you can make 200,000% overnight if you know what to do. You can make 200,000% over a period of time if you know what to do. There are strategies that you can use to make this kind of money on the blockchain. So the blockchain has higher APYs. One of the projects we look at here today is something called Olympus DAO. And when Olympus DAO started, Olympus DAO was offering as much as 200,000% APY. 200,000% APY, that is it's a lot. Okay. And they were able to offer 200,000% APY and they did not crash. And Olympus DAO is still in existence till today, 5 years and 3 months later. And we're going to look at that solution very soon. Now, so on centralized finance, you're trusting human beings. On decentralized finance, you're trusting smart contracts and you're trusting code. So the main thing in decentralized finance is if you can find out what the code base of a particular project actually says, what the project code actually does. If you know what the code does, you can sleep and you can rest easy because you know what the code does. And then finally, centralized finance comes with the risks of inflation. Every money you have in a centralized project, no matter how much it is losing value every minute because of inflation. And in Nigeria has the highest inflation rates. Right now, this year alone, the rate of inflation has exceeded at least 200%. There's nothing in the market that has not doubled in price, at least nothing. So the money you had, maybe your 1 million naira in the bank as of December, does not have the same power as it had back then last year, December. It has lost value in terms of what it can purchase. The buying power of 1 million has changed and it's still changing. Okay. Recently, dollar has just gone up again compared to Naira. Okay. The value of dollar has just gone up again compared to Naira. So Naira is still losing value at a very fast rate. So any money you keep in the bank, 10 years from now, the value will be completely diminished. In Nigeria, maybe the value will be in 5 years, maybe the value of that money will be diminished more than 1,000 times, more than 10 times, sorry, by 1,000%. Inflation in the world is supposed to grow around 12%, but in Nigeria breaks all the records. Nigeria is running at an inflation rate that, is insane, okay? And that's because of, where we find ourselves. So, but on the blockchain, you can take any amount of money and you can give it value, which is why I tell people, okay, your eye needs to be on the lookout on investment potentials that you can put your money or part of your money, and that money can generate value, can work for you so that you are not the only one working hard for money. The summary of all I have said here is number one, in decentralized finance, we are no longer trusting individuals. We are trusting code. In decentralized finance, code is the new governor. We are no longer trusting what people are telling us. We are trusting in what the code is saying and what the code can do. And based on this, there's no politics. There's no fear of what might happen. Once we know what the code can do, we know whether this is a project where they can block our withdrawal, whether they can block our assets. There are ways we can check all of those things, which you are going to see on this call today. How to check the code base of any project so you know what the project can do and what the project cannot do. All right. Now, proceeding forward, okay, we need to start talking about decentralized finance, the story of decentralized finance, so that you understand how you can start making money. Because we said we're going to talk about the high risk strategies and the low risk strategies. When Bitcoin started, okay, those were the early days of decentralized finance. The major technology then was what is called the automated market maker. That is the technology that sets the price of tokens automatically. on the blockchain. So whether it's a coin, whether it's a token, that is what sets the price automatically, this automated market maker. So once someone creates a token, okay, part of what you provide when you're creating a token is money in something called liquidity pool. Once you put some money inside liquidity pool, the mathematical formula for the automated market maker is triggered. And based on that, your assets in the liquidity pool are priced. And a trading price is set for your token or that for your cryptocurrency. Okay, because on the decentralized finance, what we have is currencies. So that coin is a currency, that token is a currency. So whoever creates that a currency puts money in the liquidity pool, okay, a price is set based on that money in the liquidity pool. Now, based on this, a lot of people who start all these currencies on the blockchain that don't have enough resources to put in their liquidity pool, what they began to do is they will make an offer. They will say, if you put your money in our liquidity pool, you can get 10% APY, 100% APY, 500% APY, meaning interest. It's like, say you have a Brody change business and you need money in that Brody change business to transact. Remember, Brody change helps people convert one currency to another currency. But to do that conversion of currency, you need to have money on your hand to run that Brody change business. So the average Brody change person also needs access to cash. If you know people that do POS, I know people that do POS that look for investors to give them money and they say, we'll give you 1%, 5%, 10% per month or per year, depending on how business is good for that person. So they take your money and they use it to facilitate their POS business, and then they pay you an interest on your capital. That is exactly the situation in this thing called liquidity pool. When you create a cryptocurrency, you need money in the liquidity pool so that people are able to change from your token or from your coin to other coins, to other tokens, and to USDT. So you need to provide what is called liquidity pool with pairs. A pair means you like USDT, BSC. Okay, USDT, yeah, Bitcoin. So BTC, USDT, BTC, meaning changing from Bitcoin to USDT and from USDT back to Bitcoin. That's a pair. So that liquidity pool determines the price. That's the first place that is looked to determine the price of a cryptocurrency. Now, because people were going to go and meet other people to help provide money in their liquidity pool, projects became very unstable. This problem became the biggest problem in DeFi 1.0. So this is the reason why there's something called rock pooling. Rock pooling comes from this problem. So you go and meet someone, the person brings money and put in your liquidity pool, you start the project, you have a big vision, you say, okay, we are going to achieve this, we are going to do this, we are going to do that. That person is bringing his money because he's going to make a profit when people are transacting under your blockchain, under your token. People are buying, people are swapping. As people are doing all that buying, swapping, and the rest, the people who have money at the back end, they are able to make money. Okay, you reward them with what they call token emissions. You reward them by minting new tokens for them at a certain percentage, so that by the time they leave your liquidity pool, they are living with profit. But the problem is that these people, the money is not locked. They can take out this liquidity pool money anytime. And when they take out the money, the price of the project is affected. In some cases, when I just saw there's this group I belong to, and the guy posted one project talking about, oh, buy the project now, buy it, buy it, buy it. So I just saw, he just came and posted something today. And he said, he just posted one of those projects that he had posted earlier and said that the project has been rock pooled. People have removed the liquidity pool. Then he now wrote something there. He now said, he now said all these degen coins. He said that's just the risks, okay, in these things that there's nothing one can do about it. Okay. So projects are crashing every day because of this issue. You don't own the liquidity money. You don't own the liquidity pool money. So because of that, the money can disappear anytime. So I see people investing in different blockchain projects that don't even know the risk. The risk of investing in any DeFi 1.0 project is that the money in the liquidity pool can vanish overnight. That is why in DeFi 1.0, the key question any blockchain person will ask you is, this project you are talking about, what is the utility? Why are they talking about utility? Because utility means that if there is a way, something you're offering, a use case for that token, for that coin, that will make a lot of people to hold the coin, to hold a minimum balance, a minimum deposit without selling it out, then that project can have a future. Meaning that even if money is low in the liquidity pool, okay, there is hope for more money to come in. Why will more money come in? Because these liquidity farmers are looking for key things. Number one, they're looking for transactions. So if your token has a use case where people can use it to do things, that means they'll keep buying it. As long as there's a use case for them to keep buying it, that means transactions will continue. So because transactions are going to continue, that is the reason why somebody is now going to come there and say, okay, I want to put my money in this liquidity pool. He's not putting his money in the liquidity pool because he likes you. He's not loyal to anybody. He's only loyal to profit. He knows that if he puts his money in that liquidity pool, he can make money because that project has a lot of transactions. There's a reason for him to put his money there because as long as transactions are taking place, he will make money. But the problem now comes if the project does not have transactions anymore, if there's no use case to make people keep buying, if it's just a pump where people buy during the pump and they dump, and they are no longer buying anymore because the price has flattened out, why should the person who, has money in the liquidity pool, why should he keep his money there? There's no reward because there are no transactions on that project. That's why in DeFi 1.0, people cry about utility. Utility was one of the ways that was thought about to solve this liquidity pool crisis. And this is where all the pump and dump projects exist. And this has been used now to scam people. When you want to scam people, you do a project that has small liquidity pool. People come and put their money. When they put their money, okay, the price will quickly rise because the liquidity pool has small money. If the money in the liquidity pool is tiny, the price grows quickly, rapidly. So based on this liquidity pool, you can manipulate any project. I saw one project the other day, the liquidity pool is $5,500. That's a project that's easy to manipulate. In fact, it's just that project is created for the purpose of manipulation and pump and dump. Because $5,500 liquidity pool means that if somebody just put $5,000 investment in that project, the price has already doubled. If somebody buys that project, $5,000, the price has doubled. That also means that the person who was holding that initial money in the project, so let's say someone had 1 million tokens, he bought 1 million tokens. At that, when the price was, like owners of the project, the developers, let's say he held 1 million tokens for himself and then put $5,500 in the liquidity pool. Once somebody brings another 5,500 and come and put inside, the price has almost doubled. So it's easy to manipulate those kind of projects compared to if a project has $5 million in the liquidity pool. You now bring $5,500. Your $5,500 will not mean anything because it's too tiny to make a change. So that's the big difference. So when you want to invest in a blockchain project, this is the key questions you need to begin to ask. The money in the liquidity pool, who owns it? Who has it? What is the reason that that person will keep that money there for that project so that we can keep transacting and so that the price will not crash? If that question cannot be answered, you are sitting on a time bomb. It does not matter what the story they are telling you. Now, you are sitting on a risky project. So that is where you need to begin to look for things like what is the utility? What is the use case? When you see that the money in the liquidity pool does not belong to the project, does not belong to the project, you need to begin to ask Okay, what is the utility? Why would people hold this token? Why would the people that have money, the liquidity pool, keep their money there? Those questions now have to come up. So because of this liquidity pool crisis, some new developers, some other developers now said, okay, what of if we changed the narrative on the blockchain? What of if we created a new kind of project? That project will not depend on external people to provide its liquidity. That project will provide its own liquidity, and its liquidity will be permanent. It will not depend on other people to provide its liquidity. These people are the people, the developers that now created this technology called protocol owned liquidity, which is the basis of this our conversation today. Protocol owned liquidity. Why does the protocol need to own the liquidity? Because if the protocol owns the liquidity, you cannot rug pull the project. If the protocol owns the liquidity, the price of the project cannot crash below a certain threshold because there is always money in that protocol. There's always money in that project. The only challenge with this model is that it comes with complexities. Unlike DeFi 1.0 projects, where you can have a project that just have one smart contract and the purpose is just pump and dump. On DeFi 2.0, you are looking at a different system entirely. You are looking at what is called a DAO, a decentralized autonomous organization. Now, it's possible to run a DAO, have a DAO that is not a protocol-owned liquidity model, meaning a decentralized autonomous organization where the liquidity pool does not belong to the project. But in this particular model called protocol-owned liquidity, you have
Hello?
DAO, and in that DAO, the entire liquidity
Valor is Zoom call.
belongs, the entire
Valor is
liquidity
Zoom.
belongs to the project. Okay? It does not belong to any other individual. It belongs to the project. Now, belonging to the project now provides a certain kind of safety. That now means that, okay, that money cannot go anywhere. That money is permanent in the protocol, and that money does not leave the protocol. Okay? So this solution now gave birth to a different kind of project. In this project, the goal is price stability. The goal is not holding for the price to pump. The goal of this project is price stability. And on this kind of project, you don't make money by holding, waiting for the price to pump. You make money by staking. You stake and then you earn an interest, what is called an APY. Depending on how long you stake your money, you are paid an interest in the native token of that project. So that is the model that these guys call Olympus DAO invented. They are the ones that invented this model called protocol on liquidity. And now, just to show you evidence, okay, so you know that you are dealing with something that is real. It's out there on the internet. It's not like these are not made up stories to just excite you. What I'm going to do now, I'm going to go to the internet and just share with you. Google, we'll go to Google and we'll research by ourselves live on Google, and you see what I'm talking about. So if you come to Google here, okay, I'm sharing my Google, my browser, okay, and I'm just going to say, give me a tabular comparison between pump and dump projects, which is the hallmark of DeFi 1.0, and protocol owned liquidity projects. That's what I just typed in the chat. Okay. Tabular comparison between pump and dump projects and protocol owned liquidity projects. Pump and dump projects, remember, that's what you have when the project, most projects on DeFi 1.0 are pump and dump. Okay. Meaning you only make money when the price goes up. And when the price goes up, everybody dumps and wait for the next wave. Bitcoin is the father of them all, is the father of pump and dump projects. So You can make money with pump and dump projects. You can make money overnight with pump and dump projects, but those are high risk ways of making money on the blockchain. Very high risk. Okay, hold, because the price can crash on you. Why? The liquidity pool can be removed anytime. The money, the liquidity can be removed anytime, and you will not be informed when the money is being taken out. That's the biggest challenge. And the people that put their money in the liquidity pool may not necessarily be the developers. Developers can put money in liquidity pool, and developers can remove that money from the liquidity pool. Investors can put money in liquidity pool, and those same investors can take out their money from the liquidity pool. They will not inform anybody. So it's a risky way to make money on the blockchain. There are so many things that you cannot control, that even the developers cannot control in many cases. So things, the price can be flattened at any time just because of the fact that the money in the liquidity pool belongs to external farmers and is not locked. So look at the difference. Who is the primary beneficiary of a pump and dump projects? Early insiders and creators. Who is the primary beneficiary of a protocol-owned liquidity project? The entire community. How quickly can you make money on the pump and dump project? Near instant, explosive returns. You can make 100,000x on a pump and dump project, but it comes with real risk. You must be aware of the risks. How quickly can you make money on a protocol-owned liquidity project? Is gradual, it is sustainable, and it's long-term yield. Is yield. You stake and you earn based on yield. You are minting the token. The token is minted and you are rewarded with the token because you are holding for long. Liquidity stability. As you see, liquidity matter now. What's the liquidity stability of a pump and dump project? The answer is 0. Liquidity disappears instantly because, again, it is in the hand of individuals. It does not belong to the project. It can belong to the project owner, but the same way the project owner can remove the money at any time. What is the liquidity stability of a protocol on liquidity project? It's permanent. You need to understand what is the benefit of this. The benefit of this that because the liquidity is permanent and does not go away, there's a price floor, a soft price floor for this kind of project. Price floor means that the price cannot crash below a certain threshold. We have not yet heard of a protocol on liquidity project that went to 0, even $1 safe. We've not heard of that project. That was protocol on liquidity that hit $1. We have not heard of that project yet. Why? Because the liquidity has depth, is much. The money in the liquidity pool is much. Number one, is plenty money, number one. And number two, is permanent. Because it's permanent, the price cannot crash below a certain level. So you see the liquidity cannot be rock pulled. This is Google. This is Google that we are looking at right now. Price floor, as you can see, token price floor. In pump and dump projects, there's none. The price can drop to absolute 0. That's what you're seeing here. What happened with the one for protocol on liquidity? It has a price floor that is supported by the protocol's backing assets. That is what is in the treasury. So every protocol on liquidity project has money in the treasury. That money in the treasury is what creates what is called price floor that is supported by the protocol's backing assets. Okay, those backing assets are in something called the treasury. Investor skill set requires high speed and market timing. So to do a pump and dump project, you need what? Market timing. You cannot sleep at night. You need to be looking at the project. You need to know when to take out your money, because 1 second that you leave your money there at the wrong time, you lose everything. What of the protocol on liquidity project? It rewards long-term holding and governance participation. Long-term holding and governance participation. It rewards longer-term holding. Okay. Let me leave slippage and trading fees. Project longevity. What's the project longevity for pump and dump project? Hours to days. The pump does not last. Can crash anytime on you. Only Bitcoin has been able to exceed this hours to days. Bitcoin has been able to hold, okay, the key projects, Bitcoin, Ethereum, Solana, they've been able to hold their pump and the price of the pump for certain durations that are sometimes months, but not years, months. Bitcoin price rises and crashes every year. It cannot maintain a particular price for a long time. That's just the situation. Next up, what are protocol on liquidity projects? The prices last months to years. The project lasts months to years. Now, but pump and dump projects don't even last they don't last more than this for a real pump and dump project. Once the people make money because they are doing liquidity pool manipulation, once they make money, they remove their money from the liquidity pool and they rock pull the project and everybody goes home crying. So, part of what you can see the summary here, protocol on liquidity benefits. The benefits center on sustainability and security. By owning its trading pools, the protocol ensure that users can always trade the token safely. Are you seeing? By owning what? Its trading pools. By owning its trading pools, what happened? The protocol ensures that the users can always trade the token safely without relying on fickle external yield farmers who might withdraw capital during a market scare. So you see why they withdraw money during the market scare? Yeah, the presentation is recorded, and I will share the recording, Mr. Billionaire. Okay. So are you seeing the challenge? So now, let me ask another question. Okay. What is protocol-owned liquidity exactly? Okay. So for someone who maybe is still not convinced, what is protocol-owned liquidity exactly? So I've asked the question. And you can do all those interactions by yourself on Google. I normally say use Google because Google is going to be pulling out its answers from existing research. Okay. Protocol on liquidity. Exactly. So it's trying to, even though my typing is wrong, but it will figure it out. Look at it. It's a decentralized finance model where a crypto project owns and controls its trading pools instead of renting from users. It owns and controls its trading pool instead of what? Renting from users. It solves the problem of rented liquidity. So look at what it says. Traditional decentralized finance projects use liquidity mining. They pay users high token rewards to deposit funds in trading pools like Uniswap. So these users are fickle yield farmers. They leave as soon as the rewards drop. This drains the project's liquidities and crashes the token price. Are you seeing? It crashes the token price. So how the protocol on liquidity solve this problem? Instead of begging users to lend capital, the project acquires it what? Permanently. So in this model, the user has assets, DAI, Ethereum, deposits it into the protocol through what they call bond mechanism. The project gives that user tokens at a discount, okay? And then that liquidity, that money that the user is paying to buy those tokens is deposited in the treasury and remains there permanently. So the project sells its native tokens at a discount. The payment users pays using crypto assets like USDT, DAI, Ethereum. Okay. The treasury, the protocol now stores all these USDT, DAI, Ethereum inside the treasury forever. Forever. Now, the protocol places these assets that is inside the treasury, it places it into the decentralized exchange to facilitate trading. So instead of renting money from people who will take their money and disappear, the protocol raises money by selling its tokens at a discount. And as people are buying the token at a discount, all that money goes to the treasury, and the treasury money is deposited in the liquidity pool, and it is kept there forever. Cannot be withdrawn. You see the difference? So why this matters? There's nothing like rock pulling here. No rock pulling. External market makers cannot suddenly pull out liquidity. Continuous revenue. The protocol earns trading fees generated by the pool. So, why do those liquidity farmers bring their money to the liquidity pool? Because of profit. They give you their money in the liquidity pool, and then you are paying them an interest for as long as their money is on the liquidity pool. That's what is called rented liquidity. Now, because you're not renting liquidity, all the profit generated in the liquidity pool is claimed by the protocol. It is claimed by the treasury. So the treasury makes this profit. Number 3, price floor. The treasury assets provide a literal backstop. Are you listening? Backstop for the token's value. So the price cannot fall below a certain price. Long-term focus. Developers spend time building futures instead of running around looking for yield farmers that will bring their money and put in their projects. This is a complete game changer. The challenge is that it becomes that you hardly find this kind of projects on the blockchain. They are not much. The reason why they are not much is because they come with a certain level of complexity. Okay? Because you must write multiple smart contracts. You need to write the treasury, bond, staking, vesting. There are all kinds of smart contracts. Olympus DAO that invented this model had 30 smart contracts. Last question I want to ask. What was the APY that Olympus DAO offered when they launched? Okay. What was the APY? How much was Olympus DAO giving if you stick with Olympus DAO when they started? Okay. So I'm waiting for the answer here. Okay. Scroll down. Scroll down. Okay. Look at it. When Olympus DAO launched in March 2021, its initial staking APY was what? Eye-popping 100,000% and 200,000%. Are you listening? 100,000% was the APY, meaning 200,000%. If you staked $1,000, you could have made $1 million to $2 million. That's how crazy and how eye-popping their offer was. Yeah, you could make $2 million US from just $1,000 investment. But that APY was not static, because Olympus DAO argued that you cannot offer this a flat and a fixed APY in all market conditions. That is not realistic. That the APY needs to reflect current market conditions. In stock trading and anything trading of assets, you have what is called the bear market and the bull market. Olympus DAO argued that any project that offers fixed APY in both bear market and bull market was headed to destruction. So they used something called game theory to adjust the price of the APY. And all of these were hard-coded into the smart contract. Somebody was not sitting down manually adjusting the price. It was the algorithms in the smart contract. You see why this is complicated? The algorithms in the smart contract were changing these prices dynamically on its own based on market conditions. So this is why As you can see here, say for the first several months, the protocol intentionally sustained a 4 to 5 figure APY, frequently fluctuating between 7,000 and 40,000%. So they launched with 200,000%, and then the thing began to decline, and it began to range between 7,000 and 40,000%. So where was this coming from? Staking rewards were distributed every 8 hours. Okay? It was minting the token. Olympus minted new OHM tokens whenever the price of OHM was higher than its $1 risk-free value. These newly minted tokens were continuously distributed directly to stakers. So this is an interesting project that you can come and check out. Okay? You can come and check it out. Okay? So, but this model called protocol on liquidity, which is has been researched greatly by other projects. Other projects have leveraged on it. Other projects have used it. Is the base model, which when you see this base model, you should invest. You know why? Because Olympus DAO has lasted more than 5 years and 3 months. They are experiments. Because when it started out as an experiment. The experiment worked. Okay? You can imagine giving 200,000% APY and you are still in business. So I'm going to go to CoinMarketCap and I'm going to show you Olympus DAO, show you what the price is today. Okay? And that is 5 years and 3 months later. Then I will show you how to know whether a project is protocol on liquidity. I will also show you how to confirm whether that project, okay, has the same mechanism and the same technology that Olympus DAO has, because Olympus DAO is the father of protocol on liquidity, just the same way Bitcoin is the father of pump and dump. So I'm going to coinmarketcap.com. I hit enter. All right, we are in CoinMarketCap. I'm going to come to search. Okay, click on the search bar. If you come here, you just search for Olympus. Okay. So Olympus. I'm going to click this one, Olympus V2. And I want you to look at their price chart. Now, this is not the way the price chart of the project we are going to be talking about performs, but I just want you to notice something before I show you the project we are dealing with here. First of all, notice that the price is what? 15.64. The price reached that low around 2022. Look at 2022 is when the price came to that. In fact, by 2022, the price had already reached $16, as you can see. Remember what we said. These kind of projects have what? Price floor. The floor means that the price cannot crash below that level. If you look at this project, the floor is around that $15, $16. That's the floor. So even though the price in 2022, remember they launched in 2021, March of 2021. By April of 2022, the price had reached the floor level. Now, between that 2022 and 2026, the price has not gone below that floor level. And up till now, people are able to buy, sell, stake, withdraw, all at this floor price right now that the project has not gone below. Now, because of how they did this project, you know, they were trying to raise money for the treasury. They did not have much money in the treasury, but the goal was to sell the tokens and use the token sales as a way to raise money for the treasury. Because of that, it attracted new buyers, high APY, the price went up. When the price goes up, what do people want to do? They want to sell. So good, the price came down. Okay? In this project, when the price goes down, you also have higher APYs again. Price went up, price came down. The price went up again. People were buying again because of the high APY. People were buying. They made profit. When they made profit, what did they do? They were selling because they made profit. Now, remember, these people here made profit in two ways. They made profit, number one, by staking, and the token was minted for them. And then number two, they also made profit because the price went up, because they did, Olympus DAO did pre-sales. Pre-sales is that they started selling the token at a discount. So by the time the token price started going up, people who had bought at a discount started selling out. And in Olympus DAO model that they did, they were always selling at a discount. The treasury, sorry, the bond, which is where they sell the token at a discount, was always open. Was always open. So the people were always buying at a discount and going to go and sell at high price. So after that last wave, the price now came to what they call floor price. And the price stayed at the floor price up till date. It has not gone below the floor price. So the price has been on the floor price for more than 4 years. And that floor price we are talking about here is 16, 19, 18. So it has been fluctuating between 15, 19, 18, 20, 22, like that. It has been on the floor price. Now, if somebody bought here, which we are going to show you, we are going to go to their chain and go and see something. Okay, you see people that have bought and they are still holding their units. And if you look, because the more you hold, the more the tokens is printed for you. If you are able to amass a lot of tokens, even at $1, you still be making a lot of money. At $1, you will still be making a lot of money on this kind of project. So now, before we leave this page, two things you need to know. How do you check the liquidity pool of a project? When you come to CoinMarketCap, come to Olympus here, you see markets. So you see the name of the token and you see markets, or the name of that project and you see markets. So like this one, you say Olympus markets, okay? You come here. So when you come here, scroll to the right, okay? You see the money in the liquidity, okay? This one has money in different liquidity pools. It has money in Uniswap, it has money in Curve, it has money in Sushi Swap, it has money in Curve again here, Uniswap version 3, Sushi Swap, different. If you add all this money it has in the liquidity pool, it's more than $4 million. And this money in the liquidity pool is what? Based on what we've thought so far, it is permanent. It is not going anywhere. It cannot be rock pulled. It cannot be removed. It is this money, this liquidity that forms a base that makes sure that the price does not crash below a certain threshold, as you have seen. This liquidity does not go anywhere. It's permanent. Now, this is why I normally like to say, if you are investing in it, let's say you see a crypto project, they say it's a crypto project, but they are doing MLM. A crypto project that is doing MLM. And they are saying that you can invest money, they will pay you this, they'll pay you that. They are doing all those kind of payment scheme. Now, make sure that the money in their liquidity pool is in decentralized exchange. Most of their money must be in decentralized exchange, because decentralized exchange does not have regulations. Many times projects have crashed, not even because the people wanted to crash it, but just because it was centralized. Centralized is like saying that you are running an investment business and the money for that investment business is inside First Bank. If First Bank sees 30 billion or 1 trillion in your bank accounts, they're obligated to tell CBN, they're obligated to tell EFCC. EFCC is going to come and ask you, how come you have 1 trillion in the bank accounts? What is the insurance of this money? What are you doing exactly? Even if you are doing a investment business and people are investing in the business, they will pause your account first. They'll block the account first. They'll freeze it first for you to come and give explanation for the money. That time that they're going to freeze the account, you will not be able to pay, you will not be able to do, people will not be able to do withdrawals, transactions will begin to be slow because you are busy explaining yourself. Before you know, panic has started. Before you know, investors want to pull out their funds. Before you know, bad news has spread that the thing is not paying again. Before you know, the thing is crashing. That is the problem with centralized. On the blockchain also, there are centralized exchanges like Binance, BitGet, they are centralized exchanges. If a investment project, a blockchain so-called investment project has its liquidity pool in centralized exchanges only, there's a challenge. That means that project is at risk. Now, I did not say you should not invest. I say just know the risk. The risk is that because the liquidity pool is in a centralized solution, that liquidity pool can be flagged, that liquidity pool can be banned, that liquidity pool can be frozen. There are so many things that can happen because it is centralized. Now, when you come to decentralized, the liquidity pool is free from all those regulations. Okay, so here you can check whether it's a centralized exchange that the liquidity pool is or in decentralized exchange. And also you need to look at how much is in the liquidity pool. If you see a liquidity pool of $5,500, $1,000, $128, $500, all of those are projects that are created just to manipulate, just to do pump and dump. That's it. And like I said, you also need to check, is this liquidity, is this project a protocol-owned liquidity? So you know, if it is not a protocol-owned liquidity, you know that, okay, the risk is that that liquidity can vanish anytime. And when it vanishes, the project will do what? Will suffer. All right. Now, one of the things you will notice in a protocol-owned liquidity project is that the top holder wallet seems to hold a lot of money. Okay? So like now I went to holders. I went here to CoinMarketCap. I've clicked on holders here. And it's going to show me the holders. You will notice that the holders, the top wallet seems to hold a lot of money. Like you can see, this one, the wallet is holding 70% of the assets here. 70%. Now, when you see this in blockchain, in DeFi 1.0, this is a classic case of rock pulling because the day that this person will remove his money, everybody will suffer. But to investigate this wallet to know if this belongs to an individual or if it belongs to the protocol, you need to go to the blockchain directly to go and check, not CoinMarketCap. So to do that, you come here. On the left-hand side, you see Explorers. You click on the Explorer here. This project, Olympus DAO, was done on Ethereum. So the scan is Etherscan. You click on that Etherscan here, it will take you to that project on the blockchain. Down here, you'll be able to see the first way you can identify a protocol on liquidity project. The first way you can identify a protocol on liquidity project, you see it here now. So when the thing opens up, as you can see, we have holders. It's still loading though. We have holders, we have transfers. Okay. We wait for it to load. When it finishes loading, you scroll down and you go and look at that top wallet that was 70%. Look at the wallet, 70%. If you notice, this is not somebody's wallet. This is what? This is a contract. This is the first way you know a protocol on liquidity project. That top wallet is usually what? A contract. The wallets that seem to have a lot of assets, this one is 18%, 6%, 2%. All of those are what? This one is smart accounts. This one is smart accounts. This one is contract. And you can see Uniswap. This money is in the swap. It's in the liquidity pool. Uniswap. This money is a liquidity pool. Staking. This is in the treasury. Okay. Uniswap. Liquidity pool. All this, where you see contract, you know that that money is not in somebody's wallet. It is protocol assets, treasury assets. This is somebody's wallet. This one does not have any contract in front. It's somebody's wallet. Number 6. Look at how many tokens this person has. 21,000 tokens. How much is his token valued at, even at $16? His token is valued at $339,000. Now, if you come here 5 years and 3 months later, come to transfers, you will notice that there is still action in this project. People are still withdrawing. People are still staking. People are still taking. Look at 6 minutes ago. 6 minutes ago. Okay? 6 minutes ago. Look at this transaction. Look at this transaction. That is a withdrawal transaction, which I'm very sure of because of what is called vesting. This project has something called vesting, which I'm not going to explain now anyway, but I just want to show that they're transactions. That's the first way to confirm that the project is protocol on liquidity. The second way is to go to CETIC. First, we've checked the top wallets have contract signed, meaning that that money is in a contract. That money does not belong to an individual. The second way to check is to come to CETIC. Now we want to check the code base to see what the code base says, because you are not a developer. A crypto project can write a malicious code and you go and put your money because you don't know how to check whether the code is malicious or not. So you come here. This is the largest blockchain security auditor. They are auditors. Does not mean that every project that you find here is credible, but it just means that every project you find here have taken the time to say, audit me and publish a report for me. So they will audit and they'll publish a report. So if you come here now and click on Skynet rating, okay, Skynet rating will now take you sorry about that. My computer is hanging a bit. So I'm trying to open this page. I'm trying to open Skynet rating. All right. Okay. It's saying my page is unresponsive. Okay, I'm still clicking on Skynet rating. 1 minute. Stop sharing and reshare. Okay. All right. As I stop sharing, it has opened now. So let me share again. I hope you're getting value so far. If you're getting value, let me hear in the chat that I'm liking what I'm hearing. I'm getting value. If you're getting value, let me know you're getting value. All right, we are back here. So now we are here again. We clicked on Skynet rating. We came here. I'm going to now look for Olympus. And I'm going to click on Olympus V1. Just click here. So when you search for a project and open the project will open up. If the project is here on CETIC, if CETIC has record on the project. Okay. Now, the thing I want you to notice here, scroll down. Okay, first of all, look at this. This project is 5 years and 3 months, as you can see. 5 years and 3 months, okay? This project in the last 7 days has $26,000 worth of transactions. $26,000 worth of transactions. The investors that have made this transaction, the highest transactions have come from Falkland Island, Greenland, and Chile. There has been 145 transactions on this project in the last 7 days, and it is a volume of $26,000. This is 5 years and 3 months later. Now, if you come down to where the code base is, where they talk about some of the things about the code, Okay, now look at this. Because this project is a DAO, there's something called contract uncertainty. Part of the contract uncertainty, you are going to see external core risks. In every protocol on liquidity project, there's external core risks. So if you see a project that has something that looks like money in contracts, but you come here and that project does not have external core risks, it is not a protocol on liquidity project. Every protocol on liquidity project has external core risks. Do you know why? Because it has multiple smart contracts that are working together. When this smart contract is talking to another smart contract, and you have 30 smart contracts like in Olympus DAO, it creates external calls. They are calling each other. So there is going to be this external call risks. Now, they are just telling you that you should know that this project has external call. You see, like I told you that SETIC just tells you what they have found in the code. That's it. They tell you what they found. So they've told you that this code has what? External call. Number two, they've told you that this code has means function. Where does means function come from? Staking reward. Okay? Remember, you stake and you earn. On this project, you are earning from staking. Okay? So because you're earning from staking, there is what they call means function. Now, that's the second thing you see in every protocol on liquidity project. Because of staking, there's mean function. Number three, ownership renounce. This particular project did not renounce ownership, meaning they maintain access to their smart contracts. They can modify their smart contracts. They have what is called, they have privileges. Ownership privileges were retained by them. Okay? Now, does not mean that all protocol on liquidity projects retain privileges. No, this particular one retain privileges. Okay. So now with all of that said, I've shown you the way to identify, number one, a protocol on liquidity project. Number two, how much money is in the liquidity pool of any project. Number three, how to check whether the liquidity pool is centralized or decentralized for any project. Number four, how to go to the chain and go and check whether the money in the project stop wallet, whether it is in an individual's wallet or whether it's in a smart contract. Number five, I've brought you here to SETIC and I've showed you that every protocol on liquidity project will have what? External core risks and main function. All of this research I've done based on what? Olympus DAO. We've not talked about the project why we are here today. So now we want to talk about our own project. So I'm going to stop sharing my screen here for a while and I'm going to go back to my presentation to start rounding up and start introducing one or two facts about the project we are talking about. The project we are talking about is not a protocol only, it's not just a protocol on liquidity project. It's not a DeFi 2.0 project. It's a DeFi 3.5 project. And I'm going to explain why it is a DeFi 3.5 project shortly. Okay. So first of all, after DeFi 2.0, we had DeFi 3.0. DeFi 3.0 saw the introduction, okay, of scalability solutions. Every blockchain began to think of how can we scale? How can we increase our numbers? How can we increase our user base? How can we have more people holding? How can we have more people transacting on our platform? Because the more transactions, the more the liquidity providers are happy to stay with you, the more also you can have enough liquidity money in the system. Because if more users are coming to buy, that means more users are holding. So in DeFi 3.0, you had the invention of things like referral mechanism. That is when all the Bybit, the Binance, the BitGet, all of them began to do referral mechanism. They began to do better dApps because DeFi 1.0 was so complicated. I don't know whether you remember those days that crypto was so complicated, so complicated. You need to have all these multiple apps to do what they call bridging, to do what to move asset from one place to another place. My dear, was just ridiculously complicated. But today, we have a lot of technology now that have come to make access, number one, easier, and also ability to transact easier for people who are not technical. So user retention was a big deal here. It is here that you have what they call dApps were invented in DeFi 3.0. Referral mechanism was invented here. Reward programs, incentive. The reason why you did not hear about Olympus DAO is because the people that bought it were not incentivized to tell people about it. There was no, I'm in this call now telling you about this project because there's an incentive to tell you about the project. Other than that, I will just invest and go and sleep. Why should I tell you? There's no reward for telling you. Okay? So now we have referral incentives on the blockchain because of DeFi 3.0. And then from there, you now come to DeFi 3.5, which is the introduction of artificial intelligence. So you now take what we had in DeFi 1.0, which is the automated market maker, take protocol on liquidity, which is DeFi 2.0, bring in scalability solutions, which is like having a dApp, having better, easy to use user interface, having referral mechanisms, and all that. You now add artificial intelligence on top. Now, take note, before you add artificial intelligence, you are adding it on something that is working. You cannot take MMM that we did in Nigeria, which is a failed model that has failed every time. You cannot take that model and you add artificial intelligence. It is still going to crash. Artificial intelligence is not going to make it not to crash. First of all, you take a model that has worked, a model that has broken records, and then you add AI to it. Now we understand you're making it better. You take a Toyota Camry, you add AC, you add AI navigation system. Now you're talking, you don't take a broken model that has failed, and then you now go and begin to add AI to it. It doesn't make any sense, which is what I see today with many projects. You are taking a broken model or a model that is unproven, and you now begin to add AI to it, and people are still running there because they are hearing AI. So be smart. So what Horizon has done, okay, they have taken this proven model that has worked, that has prevailed, that has produced results, that has lasted 5 years and 3 months. They just took that same model and they just added AI to it. And they also made some changes based on the mistakes that they felt Olympus DAO made, because Olympus DAO was the first mover. They studied different people who did the protocol on liquidity model. They studied the most successful POL models, the most successful. And then they learned from their mistakes and made this project, but they added AI to it. And as you can see, their price has been what? Stable. I'm going to go to the blockchain and show you this, why the price is stable. And then I'm also going to show you that it is protocol on liquidity. I'm going to show you, okay, that it has the what they call external call and mint function. And I'm going to show you in this particular one, they have renounced, it has been renounced. So what are the core futures? All these futures are futures from Olympus DAO. Minting. You stake and you earn based on the minting. Number 2, dynamic APY. The APY is not static. The APY of this project started at 1,800. Today, it is around 1,100. So the APY is not static. The APY changes. It goes up, comes down, goes up, come down. Sustainable model. This model has been proven. This model called protocol on liquidity has been what? Proven. It is flexible, it's transparent, and it's a smart model that is lasting. Number 4, you have what is called the automated market regulator, which is what keeps the price stable. And I'm going to explain this in a moment. What this does to make sure that the price is a straight line like you have seen here. Because when you look at this project over time, you see that the price is stable. So what this automated market regulator basically does is when people sell their tokens, in other words, you dump for USDT, the AI instructs the treasury to take money from the treasury and go and buy dump tokens. Maybe not all the dump tokens, but there's an algorithm it will use to buy dump tokens. enough to make sure that the price is not affected. Because what he will do, he will go to the market, buy the dump tokens, and then remove those dump tokens from circulation so that the dump tokens will not affect the price of the protocol. Now, when those dump tokens are purchased and removed from circulation, the price stabilizes. Now, it will now tell the protocol to stop minting the tokens, because based on the tokens that have been removed from circulation, it can take those tokens and give to people that are staking. So stop minting, take what you have, give to people that are minting. That way, it does not just do inflationary printing of new tokens, which will cause inflation and dilution in the future. It tries to make sure that it is not printing when it should not be printing or minting new tokens. These are the 4 key features of this model. All the smart contracts are open source. If you have a developer that is good with Web3 projects, you can always find our smart contracts on Telegram. All the links are available, and you can take those links and you can take those contracts and go and investigate them and look at them to ensure that they are saying what they actually do. Okay? So this project has been certified on CETIC, and not just that, it is an award-winning, let me not say award-winning, it is a spotlight project on CETIC here. Spotlight project meaning that after CETIC audited them, they put them in the category of what is called AI innovators, and they are number 9 on the list of AI innovators. They are open source. They renounce their contract fully, meaning they have relinquished all ownership. They cannot modify the smart contract. They don't have any smart contract, any proxy contract, and they don't have any hidden owner. And I'm going to show you all of that in a moment on CETIC. But before we go to CETIC, I'm going to CoinMarketCap to show you that I just want to run you through what they have done differently. Now, Olympus DAO, when Olympus DAO started, remember, Olympus DAO model was they were raising money for the treasury using the bond. So this is what Olympus DAO had, something like this. Let me show you what Olympus DAO had. Olympus DAO had something like this. Okay. They had the treasury here on the right. Okay. And then they had this liquidity bond at the top showing they had their bond were always open. The only thing that they did not have here is what is called AI productive that you see, AI productive on the top right. They did not have AI, so there was no AI productive. But apart from that, if you remove the AI productive, you have Olympus DAO's model. That is what Olympus DAO had at every given time. Now, Horizon did not use the bond because Horizon realized that if you use bond, you are going to create volatility. How do you create volatility? People will buy low at the bond and then they will sell high. Buy low, sell high. Buy low, dump at the high price. That creates volatility. So Olympus DAO say we will not do that model. This is what we will do. We will put money in our treasury by ourselves instead of trying to raise money by sales, because you can raise money through bond sales. But they say, no, we'll not do bond sales. We will just put money in the treasury directly to avoid buy low and sell high. That's the first thing they did that's different from Olympus DAO. Number 2, they now said, okay, we will only use our bond when volatility raises its head. Meaning, if a time comes that the price of the token reaches 80 USDT, that is when Horizon will start selling discounts. This discount here now is to balance the sell pressure. People are trying to sell out. Remember, when the price goes up, what do people do? They try to sell. So the goal of this project is to keep the price stable because they don't want people to be selling out. So they want to keep the price stable. They don't want to become Bitcoin. This project is not trying to be the next Bitcoin. No, they want to be a stable token, which is why I call it straight line profit method. They want their price to be stable, not fluctuating up and down in terms of pumping and dumping. They don't want pumping and dumping. They want straight line. So if the price goes to 80 USDT, this bond appears. Now they'll begin to sell discount. What is the purpose of the discount? You are trying to sell. Oh yeah, we need new buyers. So sellers are selling, buyers are buying in to try to create a balance. If that does not work and people are still trying to sell, they give a steeper discount in the reserve bond. This steeper discount is still to bring in more new buyers to see if they can lower the price of the token. How? By attracting new sales while people are trying to sell out to create a balance. So instead of using the bond as the primary way to make money for the protocol, treasury, they are using the bond as a way to stabilize the price in case volatility comes. Now, volatility has not yet come, by the way. Also, part of the money that is coming from the bond, remember, the only way to send money to the treasury in Olympus DAO model is selling at the bond. So in this, whenever the bond is active also for Horizon, part of that money will be going into the treasury. Now, Olympus DAO has, Horizon has added something else, which is the AI productive. Like right now, the software is live. There's a AI music studio where you can generate music. But to use the AI music studio to generate music, I will show you music I've generated. To use that AI music studio, you need to pay. Every payment in the music studio goes directly into the treasury. So that way the treasury is making new real money. So beyond selling at the bond, the treasury makes money from real world projects also. And they are going to create more AI softwares, and all these AI softwares, people are going to use it, and the money generated there all goes into the bond. So this is the model of Horizon, and this is why the price is what? Stable. So part of what I need to now do is take you to the blockchain and show you why this is also a protocol on liquidity project. But before I do that, I'm just going to show you how you can earn on this project. And everything is based on Olympus DAO model, but the APY is different. So like I said, the APY right now is around 1,100%. It is fluctuating between 1,000 and 1,002. So the sweet spot right now is around 1,100%. So if you put, before we talk about if you put, remember, let's say you can do what they call flexi, you can do what they call fixed. Flexi means that you're not locking your money. Your money is open. You can take out your money anytime. Fixed, you can do 90 days, 180 days, and 360 days. The interest rate for each one, if you do flexi, the interest rate is lower. That is, the APY is lower. If you do fixed for 90 days, the interest rate is lower. If you do fixed for 180 days, it's slightly higher. And if you do fixed for 360 days, it is also slightly higher. Okay, the highest APY is for people that do 360 days staking. At every point during the stake, the interest is withdrawable. In other words, the profit is withdrawable. But in Flexi, both the capital and the profit is withdrawable, and it has the lowest APY. In fixed, you cannot take out your capital, but you can take out your interest. Now, there's what is called yield vesting. This is another way to prevent pump and dump. In this model of vesting, according to Olympus DAO, you cannot take out your profit at one strike. You take out your profit daily. If you say, I want to take out my profit in 180 days, you don't burn anything. You take it out in 180 days. So whatever is your profit, you have 180 ORI. You take out 1 ORI a day for 180 days and you're fine. You will not pay anything. 1 ORI a day is like saying you're withdrawing $55 a day. But that's 6 months. Now, the other option here is you can take out in 150 days. 1.5 ORI. Okay? Around 1.5 ORI But to do this one, you go and buy 5% of that your 180 ori. 5%. 10% of 180 is 18. 5% is around 9. So you would now buy 9 ori. You go and buy 9 ori, convert it to WBMB and bond. When you bond that 9 ori, you unlock the vesting. And in 150 days, you will now begin to receive 1.5 ori a day until it completely pays you your 180 ori in this 150 days. If you want to do in 100 days, the same thing, you go and buy 10%, which is 18 ori. You buy 18 ori and bond, or you buy WBMB, what that value and bond. Once you bond, you can unlock 100 days option and you begin to withdraw. The fastest time frame is 15 days. Now, somebody say, why am I burning? Because bond activity helps stabilize the price of the token. Bond activity helps to keep the project healthy. Healthy. Bitcoin is manipulating their price by burning. They do what they call halving. Every 4 years, they burn half of whatever is in circulation. That burning that they are doing is what skyrockets the price, because when you burn like that, the remaining units will become more valuable. If each unit, if you have 500 units in circulation and each 500 units is $100,000, and you now burn half of the 500 units, what you are doing is like saying the remaining units now that are left will become a potential $200,000 per one when you destroy half of it. That's what Bitcoin is doing. So when they do halving, the price literally begins to double. And then when the price begins to go up, what happens? People begin to buy into the pump. And the more people are buying into the pump, the more the price keeps skyrocketing. And then when the price goes to the all-time high, they hold for a while. They say, is it going up? Is it going up? When they realize it's not going up again, they begin to sell. And then the thing comes down again. So every 4 years, Bitcoin has that cycle. Every 4 years, Bitcoin has a massive pump and a dump. And then there are people who don't even release it. They just hold because they bought it early. They are still holding. Okay? So you must vest your profit, but you can take out your capital anytime. Capital is not subject to vesting. Profit is subject to vesting. And this is what helps to keep this. So somebody cannot just come and take out $1.5 million in an instant. That money will be broken and paid. He can take it out in 15 days. Okay? $150,000 a day. But first of all, he must burn 25% of that money. If he doesn't have, he can do 180 days. It's free. The money is not running away. But this reduces shock on the ecosystem. Okay? Now I'm going to talk about this and then I'll show you some possibilities with our profit calculator. First of all, this is just a summary. If you came in when the price was around 1,400 APY, when we had 1,400 APY, your $10,000 can become $65,000 if you did Flexi. That's in 1 year. Your $10,000 can become $65,000 on Flexi. Now, on fixed, that same $10,000 can become $139,000. The point here is that at every point in time, whatever you get with Flexi for 1 year, you get double of that amount if you did fixed for 1 year. Okay? Just showing you a comparison here. So now I'm going to stop sharing all of this. I'm going to go to the blockchain and let us just do some fact checking on Horizon. Then we are now going to use our profit calculator to show you how much you can make, okay, on this project if you started now where the APY is 1,100% APY. Now, this is not a project that you sit on the fence because this model rewards you based on an APY and the APY is not fixed. In this model, you need to come in when the APY is juicy. That's the idea. Because when you drag your leg on this kind of model, every day you are procrastinating, you are losing money. And it is possible to make a lot of money even from a small investment, which I will show you. Now, let's go to the blockchain and go and look at what they call Horizon. I'm going to share my screen in a bit, but for the purpose of hanging and all those things, where the thing is hanging, I just want to come here first and open Horizon. Then when I open Horizon here, which I've done, I will now come back and share my screen. All right, sharing my screen now in 3, 3, 2, 3, 2, 1, and go. Yeah, my screen is shared. So this is Horizon right now in the market. And the graph is still loading. But as you can see, the price today is 56. Yesterday was 55. Okay. And like we said, what they have done is they've modified the model of Olympus Dow slightly to achieve this kind of price point. Okay, the price is 55.85. That's what it is today. Okay. So as you can see, the price is fairly stable. You will not see projects like this. This is all a testimony to the AI algorithm that is managing the DAO, which is what you call the decentralized autonomous organization. The price had exceeded 60 at only one time. Other than that, it just goes between this 54 and 60. Okay, because of the buyback mechanism. What is able to do this is the buyback and minting, the management of the buyback and minting mechanism by the AI. That's what is producing these results. Now, it has just taken what Olympus DAO has done and is doing it better. Now, number 2, you know what to check liquidity pool, right? I told you how to check liquidity pool. You scroll down, go to markets. Look at it, Horizon markets, go to decentralized exchange. Make sure that the money is in decentralized exchange. It has $2.2 million, all provided by the developers. Now, you need to take note. They have not started selling in the bond. If volatility comes and the bond opens and they start selling in the bond, what will happen is that the money here will grow because of bond sales. Every sale in the bond will increase the money in the liquidity pool. Number 2 is that the other way we plan to increase money in the liquidity pool is by selling the AI softwares. So every AI software that Horizon is building, the money flows directly into the treasury. So right now there's one AI software, which like I said, I'll show you what I've been able to do with it. I'll show you music that I've generated. All right. And I paid. I paid to generate the music. Okay. So my own money also has gone into treasury. Now, next up, we want to go to the blockchain explorer and go and look at okay. If you come to holders, you will see that. By the way, any project that say they're an investment project, I saw something there. They call themselves something. Let me not call their name. But people are losing money on it right now. People money are stuck. They say it's a smart contract driven project, blah, 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 blah. When you go to their website, you see money moving on a smart contract. That's what they show you on their website. But they don't have a token. When you come here, you can't find their token. Any so-called crypto blockchain investment project that you cannot find the token, do not invest. In other words, you can't find them on CoinMarketCap, a platform like CoinMarketCap. Do not put your money. That's number 1. Number 2, I will show you when I go to the blockchain explorer. If they are giving you a smart contract and when you open the smart contract, it takes you to the explorer and you can't find holders, don't put your money. I'm not going to say more than that. Now, here you see the highest wallet is what? 55%. On DeFi 1.0, that is a potential rock pooling. So you want to check who holds this money. Is it somebody or is it a protocol? So you come to Binance Chain, here, Explorer, BSC scan, you open it up. Okay. We are about to come to a close here. So here you see, it's coming to the chain. You see the token here, Ori is the name of the token. You scroll down. Here, ACK transfers are what is it landed on, but you can see holders. Any smart contract that, if you see a project that is promoting a smart contract And that is the main smart contract they are promoting. And that smart contract they are promoting, you don't see holders. Do not invest your money. All right. So you see your transactions are taking place here. If you come to holders, you want to investigate that top wallet that had 50-something%. So you look at here, the top wallet, 55%, as you can see. It is what? A contract. The second wallet is a contract. The third wallet is a contract. The fourth wallet is a contract. Fifth wallet is a contract. Sixth wallet contract. Seven wallet contract. Eighth wallet contract. Ninth wallet is a contract. Okay. So all that contract is money that is where? Treasury. The highest holder in this project is what? 287 units. 0.0453. Okay. If it takes this money out immediately right now, it will not shake the project, as you can see. Why will it not shake the project? Because over 99, in fact, 99% of the money right now, 95% is all in the treasury. As you can see, all of this contract are in the treasury. Next thing you want to check, now you know the money, that smart contract has a wallet icon. Second thing you want to check to know if it is protocol on liquidity, you want to go and look for external core risks and main function. So you come to setting, go to search for Horizon. I'm just going to open it. Okay. So what are you looking for here? By the way, if it is not here, do not invest your money because you don't know what the project can do. You don't know what the smart contract can do. There's no way for you to tell. Any project that you cannot find a third-party audit for, please do not invest. All right, now we are here. You come here, as you can see here, you come to here, you see external core risks and main function. Okay, if you come up here, you see Spotlight Web3 AI Innovator. If you click on that, it will show you that there are only 15 projects on the entire blockchain right now that have been, let me not say only these 15 projects are AI driven, but the ones that came to CETIC, which is the largest blockchain auditor, to audit them, out of all the projects CETIC is auditing, only these 15 projects qualified as AI-driven innovator. Okay? And as we are talking right now, Horizon happens to be number 8. 1, 2, 3, 4, 5, 6, 7, 8. They are number 8 on the list right now. On the list of AI-driven, they are on the top 10 AI-driven innovators on the planet when it comes to using AI in a project. That means that they are not just, there are a lot of projects that say they are using AI. They have even come to CETIC, but CETIC cannot see what they are using AI to do. They are just the one telling us they are using AI. Okay. Now, if you scroll down here also, you see what they said about CETIC or what CETIC says about itself. And it's a Horizon connects artificial intelligence tools to a decentralized financial engine where on-chain yield is generated not by speculation, but by AI doing real work. It is transparent, it's sustainable, and permissionless. Now, it has 11.5 million transactions, $11.5 million worth of transactions in the last 7 days. As you can see, $11 million worth of transaction, and the price is what? Stable. $11 million worth of transactions, and the price is what? Stable. 37,000 transactions, and the price is stable. People are withdrawing every single day. All right. If you go down here, go and look at the code scan, the centralization scan of the code. You see that thing we talked about. You see the external core risks. You see the main function. And there's an addition here, which is sell tax. So when you are converting from ORI to USDT, you pay a sell tax. When you're converting from ORI to USDT, you pay a tax. It's like saying when you want to go and change money with Bureau de Change, okay? When you want to convert, Bureau de Change has charges. So this is like a DeFi bank. So there are charges for conversion of removing, when you want to dump the token, there's a charge. and it's 5%. And that tax is not modifiable. As you can see, they cannot modify it. Okay? They cannot pause your transaction also, and it is not anti-whale. Anti-whale meaning that they cannot stop you from withdrawing a large amount of money. You say whether the contract has a function to limit the maximum amount of transactions. There's nothing like maximum amount of transactions. You can do any number of transactions. And the maximum token positions, that you can hold any number of token positions. Okay, there's no limit. All right, it is not honeypot. There's no proxy contract. As you can see, there's no hidden owner. They cannot modify your balance. Whether the contract owner has the authority to change the balance of any token holder, that's not possible. They have completely renounced. Whether the contract owner has renounced his ownership, yes, they have renounced. They don't have owner percentage. There's no creator percentage. And they cannot retrieve ownership. Whether the contract has the function to take back ownership, no, they cannot take back ownership. So you can always come here and look around. It is open source and it does not self-destruct. These are the key risks associated with any blockchain project, according to CETIC. So CETIC checks those key risks and gives you a report. Okay? And on the report, the ones that are showing yellow is warning. Red is like critical. Okay? Yellow is warning. And like we said, on every protocol on liquidity, because of the complexity of the code. In fact, according to Google, if you go and check, Google says that the main risk in this kind of project, another risk is the complexity. Because of the complexity, you know, the code may have a bug, which is why it's very necessary for it to be what? Checked. Okay? 1 minute, guys. Sorry about my breaking transmission there. Okay? So you can always come here and check this. Check by yourself. So now that we have checked that this project is protocol on liquidity is the foundation, there's a real AI. Let me show you. Before I show you how you can register, let me show you how much you can make. So we'll go to our calculator, which you can always go to. It's called retire. I want to help you retire fast, okay? If you want to plan your retirement, you can start planning it now. Don't wait 5 years to plan your retirement. You can begin to plan how much money you can have in the next 5 years that can give you the time to travel the world, to look at some nice locations. Maybe right now you don't have access to cash. Maybe right now your income is below 100,000 a month, or maybe your income is below half a million a month. Let's say you're at that point in your life today. What can you do with this little money in your hand? Let's say your income is below 500,000 in a month. If you take just 100,000 naira from that, your 500,000 naira, and you invested it today, okay, dollar rate has changed. So let me increase this 139. Let me not do 139 because right now I've seen rates that are as high as 1,414. So let me keep it at that rate. The price of the token we just saw was 55.6 something. Okay. Let me just say 55.67. The APY says fluctuating between 1,000 and 1,100 right now. So I'm going to use 1,100. Now, I know that a lot of us want quick money. You want money you can see right now. So let's start there. Let's say you invested in this project for 3 months, okay? And in that duration, let's say the APY went from 1,000 to 1,000, okay, 1,100 to 1,000 in 3 months. 3 months is what you want to invest. So I'm going to change the investment duration to 3 months. And let's say you fix for 3 months. Okay. In 3 months, you are still going to come back and meet prices like 54, 56, and probably 58. Those are the options you have. And you fix 100,000 naira and you left it for 3 months. Okay, no, 3 months, you're not going to get these rates. 3 months, you're going to get, your rate is going to be around 650 or less. Okay, I'm just going to use an average of 650 and 600. That's the rate you have if you do. Okay, no, 3 months is less. 3 months is around 450 because the APY is lower depending on what you're fixing. So if you fix for 3 months, you're going to be looking at just 450. Yeah, let's just say average of 450 and 420 here. Okay. All right. And that's fixed. So you can make in 3 months, okay, you can make 35,000 from your 100K. Okay. These are for people who are more interested in short-term gain. Remember, this kind of project rewards long-term holders. They are the ones. I know the challenge many people have is, what of if I hold for a long time and I cannot withdraw my money at all? You know, what of if I lose the money? In Nigeria, you are still going to lose that 100,000. And you're going to lose it on things that are not going to have any long-term value. That's the reality in Nigeria. You know, like I tell people, I said, every father needs to have at least 2 ori for each child. And when they hear the 2 ori for each child, you know, the first reaction is, oh, what of if you lose the money? You know, and I'm like, what are you talking about losing the money? My daughters are doing graduation from their current school. The attire that they say we should make is 110,000 per person for my twins. So what is 100? That's 100,000 is a joke. It's a joke. I'm going to spend that money on cake. I'm going to spend that money on pizza. Pizza right now, the family bundle we normally buy is like 60 something thousand just for pizza. And then that pizza they can do twice a month, thrice a month, or at least once a month. So what are you talking about? If you sit down and look at the expenses the average parent is spending in this country, telling himself that 100,000 naira is a loss if he invests it for a long-term project, is just, the person is thinking in a backward manner, not a forward manner, because you are spending so much money on things that are going directly into the toilet, and you're not thinking about things that have a future impact on these children, their lives. Now, for someone who does not have children, why not begin to plan your wedding? Why not begin to plan your children? Why wait until they are children to begin to plan their future? Why not begin to plan it ahead? If you have an investment mechanism that you can use to plan long term, why not plan long term? Why think short term? However, it's important to talk about the short term. So I'm starting with 3 months. Now, in these 3 months, you can also decide that, oh, I'm afraid 100,000 is a lot of money to me. I don't want to lose 100,000. No problem. That's okay. 100,000, even with all the evidences that you have seen, you believe that no, they will still want to scam me. This will want to scam me. I don't want to leave my money. No problem. So let's say you want to do Flexi. Flexi will be paying you around 310. Okay. To 300 and yeah, just say 310. Okay. So if you do 3 months on Flexi, okay, this is the potential. It's still better than what the banks will give you. 100,000 on Flexi. This is 3 months, meaning you did Flexi and you leave your money for 3 months. And it's 100,000. And that means you bought today. Today is when the price is this 55. This is the potential profit you can take out after 3 months from your 100K on Flexi, where the APY is 310. Okay. So again, the APY is not fixed. It can change. I'm just giving a range here. But this is what the current APY is for Flexi. Now, let us say you now say, okay, Joe, my future is very important. I've seen the potential of this project. I don't want to sit on the fence. I'm going to start with what I have. I'm going to do 100,000 for 2 years. I'm going to fix it. Now, take that 100,000, come back to fix, change the game to 24 months. Okay. Move it to 1,100 here. And let's say in 24 months, the price has even reduced to 300. I'm just giving an assumption. Let me just say the price has reduced to 400 in 24 months from now. And you came in with 100,000, you left it for 24 months. This is the potential profit. Now, let us say in 24 months, the price could be $25. I'm assuming. I don't know. But from the AI mechanism that we have, as you can see, on Olympus Dow, 1 year later, in Olympus Dow, the price had crashed. Olympus Dow started at around 500. The price crashed to 15. It started in March of, okay, May of 2021. By May of 2022, the price had crashed to 12, to around 15, 18, $20. Only 1 year that they maintained that price. You know, the price went up, pump, and then the price now dump. You know, they had pump and dump. As you can see, this project is 9 months already. Not 9 months, sorry, 11 months. Last year, July is when they launched. Next year, we'll make the project 1 year. 1 year later, the price is steady. So if you are looking at the price, as you can see from the price, it has already broken the limit of Olympus Dow. Olympus Dow, exactly 1 year later, the price had dumped. This one, 1 year later, the price is still stable. July will prove that, and we're about to enter July. Okay? So you can already tell. So if, let's say, something goes wrong, let's just do worst case scenario, and the price crashes to $25, your 100,000 can become 2 million. If the price stays strong and steady, your 100,000 can become 4 million. But that's nothing compared to the person who now says no. Like I'm advising, take this 100,000. In fact, not even 100,000, $100. 2 ori. Me, I say 2 ori for every child. If you think your future is worth anything, 2 ori. But let's even say, okay, I don't have 2 ori, sir. I have only 100,000. 100,000 in 60 months. If the APY crashes to even 100 or 50. Now, take note. How does the APY work? When you have more users, the APY reduces. When you have less users, the APY increases. The reality of the fact is that down the road, the APY will increase because more people would have unstaked earlier. More people will do short term. Only a few people. That's why the rich are few. Only a few people. They say the wealth of the world, 96% of the wealth of this world is controlled by 4% of the population. 4% control 96% of the wealth. Then the other 96% of people in this planet are struggling for 4% of the wealth. As you can see, Elon Musk, him alone is richer than all the rich men put together. He's richer than all the rich men put together. That's the kind of thing we're talking about. In this world, the people that are rich control 96% of everything. And the poor struggle for 4%. Why? Because the poor have a way they think. And part of the way they think is they never think long term. They always think short term. When Elon Musk was investing in Starship, investing in SpaceX, he looked stupid because he was blowing money. He almost went bankrupt. In fact, it was the last trial. If they failed that last trial, he would have been bankrupt. All the profit he made from selling PayPal, he would have lost it. But he still went ahead. Even with the risk of losing everything, he went ahead and did it. But he took his last money and gave to the lady that he got from NASA, who was running SpaceX. And she put everything in the project. And for some reason, it worked. They did something that has never been done before. Throw a pencil up to the sky and the pencil will somersault and come and stand. That has never been done before. It was at the risk of losing everything that he made that thing work. Today, Everybody is enjoying the benefits. Now, because of that technology, he has Starlink. Starlink is a product of that technology. Being able to send those rockets to the moon is what has produced Starlink, because now he can put satellites by himself, take his satellites and put there all over the world. SpaceX, that just did the highest IPO, is all of that is that technology. So what is your risk profile? How long are you planning for? Are you planning for the next 2 months? Or are you just planning for the next week? Because some people are just planning for next week. Meanwhile, some people are planning for next year. And some people already have 10 years planned out. Yes, everything might not go according to plan, but there's a plan, because without a vision, the people perish. What's your plan for 60 months? 60 months is 5 years. 5 years from now, we're going to have a change of government, another change of government. There'll be a change of government next year. Okay. Then there'll be another change of government 5 years from now. 5 years from now, when there's that other change of government, how much will you be worth? How much can you risk for that future? And this is a smart risk, so because this risk we are talking about a risk that is based on a proven model. Not all this pump and dump and not all these investment scams that are running everywhere. This is not a centralized solution where you say, oh, you need to log into something. There's nothing like that. Everything is on chain. Smart contracts. Exactly the way Olympus DAO had it, just better than what Olympus DAO did, with certain modifications and AI upgrade. Look at what your 100,000 can be in the next 60 months. There are people that have this money right now. This is the money that they used to buy, what do you call it? Rolls Royce. Rolls Royce around $500,000. You may not have this money now, but what will this kind of money do for you if you were able to touch this money 5 years from now? A lot of people are going to live and die. They will never see this kind of money. Now, let me show you something. Let's say the price of the token crashes, okay, to $1. $1, which is impossible, but let's just use it. Let's just have that text case. You will still be making $9 million profit. By the way, this is not how much you really make. This is how much you make if you do 15 days vesting. If you do 180-day vesting to collect your full earning, this is how much you're looking at. Your 100,000 naira can become 700 million, 687 million. And when you hear that kind of money, you think that, is it not too much? Is it not a scam? Okay, what of $1? Can you believe for even $1? 12 million. Can you believe for that? Is your 100,000 worthy enough to work for you and generate 12 million for you? Or you still believe that no, it's a scam, there's something you're hiding? I've shown you Olympus DAO. You can go and research Origin. There are different POLs out there. You can research how these POLs have done. But I'm showing you a different model of protocol on liquidity that has been really optimized for profits. But if you say, Joe, I believe you, I want to do 2 ORI, I'm going to, let me look, okay, no, let me keep the mathematics in Naira. No, okay, let me keep the mathematics in Naira. Yeah, let me keep it in Naira. 2 ORI right now, $55, like 110, just say 160K, okay? Right now. 160K can mean your first billion. It's like Elon Musk saying that, if I do SpaceX, I could become a billionaire. And somebody is saying, no, it's not possible. You can't make it. It will not work. That thing you are saying is impossible. And Elon Musk's case, he doesn't even have any model to go by that say, okay, somebody did it before. Nobody had done it before. It was a gamble. It can work, it may not work, but he did it anyway. He took the risk. He took the risk on batteries, on energy, on batteries that can power cars, electric cars. He took the risks and it worked. He was able to power sedan cars, took the risks on SpaceX, took the risks on Starlink. What risks are you taking today? Anyway, let's check another. I don't know. Let me see if, by the way, if there's an amount you'd like me to check for you, let me know. I can check the amount for you. This money now we are seeing here is full vesting. Okay. Now, so what I normally advise people, if you have, what do you call it? If you have a lot of money, you can do a short-term account. Okay. Ideally, you should have a short-term account and a long-term account. Okay. Okay, let's see 10,000 naira. 10,000 naira. Oh, Joe, all I have right now is 15,000 naira. 15,000 naira left for 5 years. Look at what it can become. 15,000. This is the power of compounding. This is why compounding is called the eighth wonder of the world. The eighth wonder of the world. This is why compounding is called the eighth wonder of the world. Your 15,000 naira, even at $1 exit price, let's say something wrong went. Elon Musk made an announcement that crashed. The AI got angry and disowned the buyback mechanism, and he stopped managing the price, and the thing now fell to $1. You still come out with 1.8 million 60 months from now. What of if this project maintains a strong price? I've not done calculation of the price exceeding 58. I've not, because the vision of this project is not to pump the price. Okay. At the most, their own goal is that the price should not exceed $80. That's their goal. So at $80, you can be making 147 million from your what? 15K. But I tell people, if you're serious, you have children, every child should have at least 2 ori. Yeah. Yeah. And your minimum investment for every child should be 48 months. Okay. Even though me, I believe in the 60 months. But you can have multiple accounts. You can have multiple timelines. You can have different ones. You can have 100,000 that is running for 48 months. You can have another 100,000 that is running for 60 months. And all of these monies you can take. Remember, the highest taking amount on this platform is 1 year. After 1 year, you can take out both your capital and your profit. If you leave it, it will just keep compounding. But the maximum stake duration is 1 year. So 1 year, after 1 year, your profit and your capital is claimable. But if you say, no, I want you to keep running, it will keep running. You leave it there. Let it keep running. So you can have an account that is running 3 months, another one, not even an account. You can have a package that is running 3 months, another one running 6 months, different terms like that. And so you can have 100K that you put that 100K, you want to run that one will just run for 60 months. You have another one that will run for 48 months. You have another one, you can plan yourself like that. So at different times, you can take profit at different intervals. Because the Bible say, hope deferred, maketh the heart sick. So I understand. Waiting for 60 months look like, oh my God, I'm waiting forever. No problem. You can plan it in such a way that you can reward yourself at different intervals. 3 months, 6 months, 1 year. You can plan it like that. You reward yourself at different intervals. Okay? And not necessarily have to wait for the entire duration. Okay? So, I don't know if there are questions. We can start taking questions here. If you have any particular amount you'd like me to postulate for you, $1,000 in 1 year, what would that become? $1,000 is just like saying maybe, let's just say 1.4 million. Okay. In 1 year, let's say in that 1 year, the APY goes down to 500 and you're holding for 1 year, 12 months. If you do full vesting, 180 days, you can take out your entire profit. This my $1 mathematics does not apply here, because in 1 year, the price is definitely not coming down to that. The price will still be strong. Okay, this is the potential if you do full vesting. But if you do 15 days vesting, this will be the profit. And the money we are looking at here is minus your capital. Your capital is not in this money. This is profit. Your capital is not here. So this is 55. If the price is 55 when you sell, if the price is 56 when you sell, and if the price is 80 when you sell. Okay, seems somebody's asking me a question. All right, so that's it. Closing, I'm just going to take you here to the DApp. We are done. So if you are interested in signing up on the WhatsApp channel, you can just send me a message and we can take it from there. So here's where the DApp, this is what the DApp looks like. And this is my last conversation here. So here, if you click on enter DApp, there's nothing like login. You click on enter DApp. When you enter DApp, it's going to ask you to connect your wallet, which we are not going to be able to look at now, but this is the DApp. And you can always come here. This is the AI software I talked about, Horizon. You can create an account, connect your wallet. Okay, once you create an account, connect your wallet, you will be able to see the AI studio. And from the AI studio, you can begin to generate music. Okay. Going back to the DApp. This is the DApp here where we fix staking here, flexi staking here. This is the bond which is not open. And then if you decide to promote the business, there are promotion incentives, which if there are rewards for promoting the business. I think, okay, that's probably what I can, the last slide that I can share, before we close here. So, but if you want to get started, all you just need to do is reach out in the group and we'll help you get started, okay? So closing here, if you are interested in the referral incentives, because they are referral incentive, not MLM, referral incentive. These are the main referral incentives. You get 10% of the profit that anybody you refer makes. So you brought a friend, he put $10,000. In 1 year, his $10,000 generated a profit of $140,000. You will get 10% of that $140,000 profit. This money is not paid at once. This money is paid every time he's paid. He is paid, interest is paid every 8 hours. So when he puts $10,000, every 8 hours, he will be paid an interest. Every time he's paid an interest, you are paid 10% of that interest. That is the direct referral bonus. Then the point with the one we call contribution team bonus is the summary is like 10 to 15% of the volume on each of your legs. Now, on this model, this particular product, you can refer unlimited people directly. You can have 500 legs if you want. But if you want to build the business, meaning you want to do the referral business, it's best to build 2 leg, 3 leg, or 4 legs. That way you will not stress yourself. 2 legs, if you do 2 legs and you have a volume, meaning everybody on the left leg is a value of $10,000. Everybody on this right leg is a value of $10,000. You can be earning 2,000 to 3,000 USDT every month. Now, if you labored on 3 legs, you can earn more, 10 to 20% per month. If you labor on 4 legs, you can earn 10 to 25% per month. So here is a $3,000 to $6,000 if it is 10K volume. And here is a $4,000 to $10,000 if you or 4 legs of 10K volume. Okay. So why is this figure not static? Because of the mathematics here. You have a weight coefficient times community contribution value times total network value times total daily release tokens times 80%. The only fixed values are this 80% and this weight coefficient. Okay, weight coefficient is a fixed value. Community contribution it's not a fixed value. Okay, it's also a variable depending on your referral activities. This is also a variable. This is also a variable that is not fixed. So you could earn 4 to 10K here, 3 to 6K here, and 2 to 3,000 here. The same volume on more legs. This is less work. This is more work. Okay. And in a case where you are a super nigger and you have a lot of people in your network that you can bring on board, and you can bring this kind of revenue or volume, you can be making $40,000 to $100,000 in USDT every single month. Okay, and even more. I know people that are already around here taking out at like $10,000 every day. So that's the plan. I don't know if there are questions. If there are no questions, what you need to do right now is send a message in the chat and say, okay, I want to get started. Let me know what you want to start with, and so that we can get you set up right now, and start where you are. Start where you are. Take action. Don't wait for big money. Start where you are. 10K, 20K. There's nothing like minimum package. There's no package in this business. Okay? So you start where you are. There's no package. There's no minimum investment. There's nothing like that. All right? Okay. So do we have any
Thank
questions?
you very much.
Okay, good. Thank you.
Yes, thank you very much, Mr. Joseph. I appreciate. Um, I just want to find out how often do we have the Zoom presentation?
Previously, we were running the Zoom every Tuesday, every Friday, and every Sunday. And we were having tech issues. So, but those tech issues have been resolved. So we probably will go back to the Tuesday meetings and the Friday meetings. But the guaranteed meeting that we know that is very, very consistent is this Sundays. But I'm going to
Okay,
bring
this
back,
one.
yeah, I'm going to bring back Tuesdays and Fridays. Yeah.
Okay, because it will enable us to plan with our prospects.
Okay, to bring your prospects
Because
on.
if I know that definitely there will be Zoom meeting on Tuesday, at least I will have sent message to them before now that okay, let's in preparation towards that. That's what I mean.
Okay, no problem. So let's plan with it. Yes, we can plan with it, because we
Okay,
previously there was a technology I was using that created the inconsistency, but going forward it's going to be steady. So don't worry. Tuesdays will be
okay,
here, Friday will be here, Sunday will be here. Yeah.
okay. Thank you very much. This is a
Thank
good one.
thank
People
you.
should people must hear this
Yes, sir.
because we need to liberate ourselves. All
Yes, sir.
these rubbish businesses that we are doing out there that's making people to go into, to commit suicide. We should
Exactly.
stop all, we should stop all these things and let people come and care, so that you know, they can be financially okay.
Yes.
Some people get this money, but many are scared. They don't want to put their money in the rubbish, something
Yeah,
that will
because
scam them,
people
something
have
that will
lost money. Yeah, people have lost
Yes,
money.
yes. So having this kind of projects, people we should encourage people to do at least. Look at what you are saying now. With $100 for 5 years, man, it's a good one.
It's a good
Every
one.
family should be able to, yes, every family should be able to hold, get that one, those one for their children, at least for future, so that your children will not be giving you unnecessary, you will not be having issue with them.
Yes,
Can
sir.
set up a project that you want to buy a house in Ikeja. How much is a house in Ikeja? It's $100 for 5 years, and at the end you go out. Thank you very much. I sincerely appreciate this. It's a nice opener. Thank you. I appreciate it.
You're welcome, sir. You're welcome, sir. So yeah, so that's it. Please, like we said, we'll stop the call now. So if you want to get started, just reach out in WhatsApp. You can always reach out to co-strategists um on this call, Overflow on this call, or myself. If you chat us in the group, we'll reach out to you and we can help you get started. It's a very easy process and you can be started. And by the way, we are giving free BNB to help your transaction fees so that you don't pay. You just focus on your own investment and we take care of the transaction fees of BNB for you. Okay? Thank you, guys. We can ask all questions in the group. Good night.